Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into the controversial proposal for a 50-year mortgage, a conversation that has, well, really dominated housing policy discussions all over the country. The investment thesis we're operating under is pretty simple. The 50-year mortgage is a financial trap that forces homebuyers to trade a modest $341 monthly cash flow saving for a massive $553,000 increase in total interest. And it creates a structural housing policy that ultimately worsens affordability for the next generation of buyers.
Okay, let's unpack this financial and political mess and look at the foundation of the housing crisis that even led to this radical proposal.
If we really want to understand the 50-year mortgage, you have to start with the problem it claims to solve. This policy is, it's really a desperate attempt to shore up a fundamental weakness at the base of the housing market pyramid.
And when you say pyramid, you mean the traditional flow, right? First-time buyers come in at the bottom, which lets existing owners sell and move up, keeping the whole system liquid. Exactly. But that foundation, it's crumbling. The first-time buyer has been locked out. What's fascinating here is just how quickly the demographic picture has changed. We've reached a record high for the median age of a first-time home buyer. It's hit 40 years old.
40. I had to read that figure 3 times. That's a staggering delay.
For context, the median age for a first-time buyer was only 30 back in 2010, so we've pushed people out of the starting gate by a full decade.
And this delay just ripples through the entire market. Look at the general population. The median age of any U.S. home buyer is also at a record high of 61 years old.
61.
If the youngest buyers are waiting until they're 40, they aren't cycling through the market. They start late, and, older generations hold on to their assets longer.
Which leads directly to the core problem of transaction volume.
Yeah.
If that base of the pyramid is shrinking, fewer homes are changing hands. Absolutely. And the direct result of this demographic shift is that the share of first-time buyers, it's dropped to a record low of 21%. When the most crucial segment of the market, your foundation, is that weak, the whole structure just stalls.
We're seeing a perfect economic storm driving this. It's not just high rates and high prices. Our sources highlighted that it's the broader cost of living crisis that's really hitting younger generations.
That's the critical context. We talk about home prices, we talk about interest rates, but we also have to recognize the impact of economic stagnation. You've got high student debt, you've got elevated rents, and even the destabilizing effect of AI on entry-level white-collar jobs. It just means savings and income growth aren't keeping pace.
So for many, renting is simply the only viable option.
It is. It pushes that home buying age later and later. The 50-year mortgage proposal emerged purely out of this desperation.
Which brings us to the actual math. The seductive promise of the loan, which is precisely where the financial trap lies. It's presented as a lifeline, but we need to look past the monthly number.
Oh, it's the definition of a Faustian bargain. You're trading long-term generational wealth for a temporary cash flow benefit.
Okay, let's ground this for you with some figures. We'll model a hypothetical $500,000 mortgage at 6.50% interest, which is, right around where things have been. The immediate tangible benefit of stretching that loan from 30 years to 50 is simple. Your monthly payment is reduced by about $341.
And that's real breathing room for a family that's struggling. That could be a car payment, childcare, groceries. That immediate cash flow relief is, I'll admit, undeniably powerful.
Okay, let me play devil's advocate for a moment. If a family simply cannot qualify for the 30-year payment, isn't this $341 saving a necessary evil? Why is the long-term debt guaranteed to be worse?
Because it isn't just slightly worse, it's catastrophic. Here's where it gets really interesting and, frankly, pretty shocking. That modest $341 monthly saving translates into massive long-term financial servitude. Over the full 50-year life of that loan, the buyer pays an additional $553,000 in total interest compared to the 30-year option.
Wait. So on a $500,000 house, you're saying the buyer is paying an extra $500,000 just to save $300 a month now? You're nearly doubling the entire cost of the house. That's wild.
It's almost 100% debt extraction.
Yeah.
And the pain is front-loaded just because of how mortgage amortization works. The math guarantees you build equity at a glacial pace.
And that slow equity accumulation is maybe the most insidious part of this trap. It fundamentally changes what homeownership even means. It's not an asset-building tool anymore.
Precisely. To illustrate just how slow, think about this. When the traditional 30-year loan would be fully paid off 30 years into the contract, The 50-year mortgage holder has only built up a measly 24% equity.
24%. After 3 decades of payments. That is horrifying. And the number you still owe is maybe even more important.
It is, because after 30 years of dutiful payments, the buyer still has a stunning $378,000 left to pay on the principal. You're still a lifetime away from owning your home.
And since most people move after 7 to 12 years, not 30 or 50, this minimal equity means the 50-year term isn't really ownership at all.
No, it's not. It
Hold on.
fundamentally recharacterizes the asset. Our sources describe this as much more of a rental-like arrangement.
Or housing on subscription.
Exactly. You're paying for access, you're covering the interests so the bank gets paid, but you are building very little lasting transferable wealth, which leads us directly to the structural policy flaw.
Right, because the policy, even though it's aimed at affordability, contains an economic mechanism that guarantees it will undermine its own goal.
That's the core tragedy. The plan subsidizes demand, plain and simple. By lowering the monthly payment, you're just increasing how much debt a buyer can qualify for. It lets them stretch their budgets into higher price brackets.
So we're giving buyers more leverage, more borrowing power in a market that's already suffering from severely constrained supply.
And when you inject that new leverage into a market without increasing the number of available homes, there's only one guaranteed consequence.
Home prices will rise.
Home prices will rise.
Which means the rise in prices completely erases the affordability benefit the loan was supposed to provide in the first place. You're back to square one on affordability. But now everyone is saddled with 20 extra years of debt.
It becomes a policy failure in real time, and the structural consequence is severe. The 50-year term is forced to become the new norm just to compete in the now inflated market. Future buyers will be forced into this trap.
Okay, so let's pivot to the beneficiaries. Because if the borrower is paying $500,000 extra, someone is winning big.
Oh, absolutely. The primary winners are the financial institutions and anyone already holding real estate. Banks gain massively. They secure higher total interest revenues and lock consumers into the longest possible duration. Plus, they can create more creative financial products from these longer duration instruments.
And then you have the existing homeowners and, crucially, the home builders. They benefit tremendously from the price increases, which protects their wealth.
And this is why the political origin story of this proposal is so critical. The sources detail how it was publicly floated by the FHFA director, Bill Pult. And of course, the director's family wealth is famously derived from Pulte Group, one of the nation's largest home builders.
A clear beneficiary. And the way this was introduced, it sounds utterly bizarre for a policy with such huge financial implications. Sources say Pult presented the idea to President Trump after a meeting at a golf club with the whole policy on what they describe as a roughly 3x5 poster board.
A structural shift to the entire U.S. housing finance system, presented on a poster board. It's an almost unbelievable anecdote, but it highlights how haphazard this all was. 10 minutes after that conversation, the president posted the image publicly, blindsiding his own staff.
The sources report this caused immediate internal White House fury. Officials were blindsided and were fielding angry calls from conservative allies, from the mega base, calling it bad politics and bad policy.
And the reason for that fury boils down to one major regulatory hurdle the proposal just completely ignored: the CFPB's 30-year limit on qualified mortgages.
Okay, explain for the listener why that 30-year QM limit is so important. Why can't the government-sponsored enterprises just back a 50-year loan?
Well, qualified mortgage, or QM, status exists to protect consumers and, crucially, taxpayers. It basically defines a mortgage as meeting certain stability requirements, which limits excessive risk. If government-sponsored enterprises like Fannie Mae and Freddie Mac were to back these riskier, longer-term loans, the lack of QM status would expose taxpayers to massive potential liabilities if they defaulted.
So the plan prioritizes a political headline over actual financial stability.
Exactly. It's an attempt to sidestep the very protections designed to prevent another systemic credit crisis.
So the trade-off is absolutely clear. The borrower gets a little temporary cash flow relief, which is then guaranteed to be wiped out by higher housing costs for everyone, while they sign up for guaranteed long-term financial servitude.
The final verdict, based on all the numbers, is that the plan is just a short-term political band-aid. It significantly increases the risk of default and credit destruction for the borrower because of that minimal equity accumulation. And crucially, it provides zero structural fix for the nation's severe inventory and affordability crisis. It just adds more leverage and pushes up the price.
This leaves us with a truly provocative question for you to consider. Should the entry ticket to homeownership require agreeing to nearly double the total cost of the house and remaining in a rental-like arrangement for decades, just so the asset prices for existing owners can be maintained?
It really is the generational defining question of this entire housing crisis.
It's defined, portfolio protected.